Okay, the prop desk, our class associated with trying to figure out how to make money selling credit spreads. Better yet, how not to lose money trading credit spreads. So July 22nd, 2021, middle of summer, a couple days after the Bucks win their first championship in 50 years. So we're still celebrating here in Milwaukee, Wisconsin. Joined by just a handful of folks this morning, but it's recorded, so it'll be in the podcast channel later if you want to revisit it, because I know how much you guys like listening to my voice over and over and over again. But today we're going to talk about credit spreads, and let me just kind of give you a quick overview before we go into it. All right. So one of the things this is a strategy that I was taught many, 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 many years ago. It's a strategy that is used by a lot of hedge fund managers, almost exclusively. Um, there's a lot of them that use this almost exclusively to just generate income, right? They have a substantial amount of capital that they're putting into play, $100 million, $200 million on a weekly basis. And what they're doing is they're looking to to play the math probabilities to get as best return as they can on that, right? And when I say math probabilities to get the best return they can on that, what I'm saying, I'm not saying that you're going to risk 100 to make 1,000, or you're going to risk 1,000 to make 10,000, or you're going to risk 200 to make 400. The credit spread strategy is not one like that. It's one where you are risking a certain amount of money to make maybe 10, 15, 20% return against the capital that you and collateral you've set aside to take on the position. So it's not a trade where you're looking to risk 100 to make 200. What you're doing is you're looking to risk a certain amount of money to get an extremely high probability that you're going to get a 50, 60, 70, and in many cases 100% return on the credit that you've taken on, right? So with that said, understand that any strategy that we go into from a credit or debit perspective has risks, right? So I'm going to go over the benefits and the risks associated with trading these, and then go through the execution of them. Okay. If you go in the library or podcast library, you're going to see. Not in a podcast library. In our options channel library, you're going to see the PDF associated with credit spreads. You're going to see one that's specific just to call credit spreads, and you're going to see another one here that's specific to just straight credit spreads, right? So whether it be call or put, hold on a second, whether it be call or put spreads will depend upon the direction I want to go. Okay, so let's just walk through what a call credit spread is. It is to execute the trade, right? It's simply selling a call or a put, and then buying a call or a put in the same expiration date at a strike further away from the money, which gets you a credit because the premium value of the call or the put that's closer to the money is higher than one that's further away from the money. Okay? All right. And the assumption we're using when we go into this trade is that we have either a bearish or sideways assumption, meaning we think the ticker is going to trade sideways or down. We have a bullish or a sideways assumption going into the trade, meaning we think it's going to trade sideways or we think it's going to trade up, right? In the case of a bearish / sideways sideways assumption, we're going to take credit call spreads. Just the opposite if it's a bullish, put credit call spreads. Put calls, put credit spreads, right? So that's the assumption we make going in. Now understand that because of the way we construct these trades, you've got a lot of wiggle room. So even if you're bearish, and even if the ticker moves up on you, and you place the trade strike prices effectively, the theta is going to eat away at any gain that particular option is going to get as a result of the trade in the underlying moving against your assumption, right? So you can make money three ways on a credit spread trade. You can make it in the direction that you're assuming the ticker is going to go. You can make it sideways, and you can make it even if it goes against you up to a certain amount, right? So, but ideally, what we want to do is try to figure out, is to try to figure out what direction we think something is going to go over a period of time, and make an assumption that for that based on facts, fundamentals, technicals, all kinds of stuff that you put in your market, and pick a direction and pick the strategy, put or call credit spread to take advantage of that. We're also so that's the first thing we want to have an assumption that's going to happen. So let's say we figure out a ticker and we think we have an assumption that it's going to move in whatever direction we decide it's going to move. Second thing we're looking for is IV, right? I want high IV, and in this market environment, because the implied volatility is so much lower in 2021 than it was in 2020, it's hard to find high IV, right? But so you got to search for it. I have up here 52-week high lists. This is on Tasty right here. A 52-week high list, which is sorted by IV rank, right? So, or it was sorted by IV rank. Somebody screwed around with it. So you can see 54.8. That's a 52-week high ticker, and it's only at the rank of 54. So that shows you how low IV is. So while historically I would say you want credit spreads anything above 50. You're not going to find any like that now, or so few that it doesn't make any sense to even think about that. So now what I do is I take a look. I'm looking for IV rank above 25 to trade for credit spreads, because there is a fairly substantial number of those, and those are considered high premiums. And the reason we look for higher IV rank is that the implied volatility, the higher it is, the more you're paying. There's more premium built into what the cost of the contract is, right? So we want as high as possible because we're going to be selling something. We want to always sell something at the highest possible number. And high IV means expensive, and we want to sell expensive stuff and buy back cheap stuff, right? So at 25 and above is kind of the cutoff. There's other ways to play around with that too, but I'm just going to go with let's just start with IV rank. So that's the second thing. Assumption it's going to move in one direction or the other, or sideways. High IV, a probability of profit of at least 70% on the trade, and looking for 85% probability of profit that you'll capture 50% profit on the trade. Okay? Any questions? What did Sam do? Um, 947 to 806, is that right? You see this guy's on here, Mr. Usama's typing that in here. ER wasn't that bad, 760, so we're 669. So 810, it closed at 947 today and went to 800 right now. Wow, that's a big one. All right, I digress. We'll get back to that in a minute. So probability of profit, and I'll show you how to do that using Tasty. So there's a lot of things we can do with Tasty. Tasty works that eliminates getting out a pencil and paper or a calculator and figuring stuff out, right? So what's the right way to construct this? Well, once again, we're selling an option that is at a certain place on the chain, and we're buying an option at a certain place in the chain that's further away from the money of the underlying. All right. And so let me just bring something up here as an example. What are we looking at here? I think at Etsy. Let's go Target. So let's look at Target, okay? Let's say August 20 for Target. So here's the expected move using Tasty between now and August 20th. Understand that this moves, not that much for Target, but for higher beta ticks, this thing can slide up or down quite a bit based on the underlying movement. I am not stealth. Thank you for bringing that up. Go live. Here we are. Here is, I'm recording the screen, but I wasn't showing it, so thanks for bringing that up. Richie Rich. Here's the expected move that I was mentioning for target. And so what we're going to do is we're going to take a position that is outside the expected move on one side or the other. Now I'll use this trade as an example because I have a call credit spread on target, right? Target's trading at a IV rank of 45.4. That's a pretty high IV rank, so I liked it. It's also trading close to a 52-week high, right? Let's take a look at the. Oh, I was going to see how we look at the chart on that, but no. Where were we? The target. Yeah, let's be the symbol in the chart. So this is here's the. So you're talking about a 52-week high here, right? So that's why I picked target. It's up high. It's got a high IV. So you're going to get good premium on the calls, right? Plus, I also know target is not a big mover. In other words, the expected move is not going to contract or expand on me much based on the beta of the ticker. So it's a pretty easy breezy, steady Eddie kind of play. All right, so where do I want to go here? So I've made the assumption that it's got a high IV. I already made the assumption I believe it's at a much better chance of moving sideways or down from here. And so I'm going to go with a credit call spread, right? So what does that mean? That means I'm going to look at the expected move in August, and I'm going to sell a credit. I'm going to sell a call slightly out of the expected move, which would be this one right here. 275, right? Which gives me a credit of 236. That would be if I just kept that naked. But what we do is we now buy a credit, we buy a call a little bit further out of the money than the 275. So let's say the 285. And that gives you a $121 credit at the mid. Pay attention to this. Here is the bid. Here is the ask. 113 to 130, right? This is halfway in between. Be cognizant of this on every credit trade, because this thing could be. I've seen them where this is 50 cents and this is $4, right? That's not a good trade unless you can get way up here on it, which means you'd have to sit on the bid all day long and may never get filled. Nothing wrong with that. Throw in high bids and hope steal some money from somebody. But you want to have narrow markets as possible if you want to get into a trade. Now in this particular case, you got 130, 120, 113. So what I would do is I'd probably move it up here, see if I can get 125 on the credit, right? So at 125, let's take a look at the numbers on this, all right? Ideally, what you want to do is you'd like to be able to get 1/3 of the distance here, right? So we've got a 10-point spread. 10 points. So 1/3 of that distance would be $333. We ain't even close here, okay? The reason we're not even close is because you can't find any, it's impossible to find not impossible. It's difficult to find liquid markets with high implied volatility right now. It just is, the implied volatility is just not that high on the market. So now we're stuck more with like 20% if we can get it, or 15%, or 12%, like in this case, right? So ideally 33%, in this case it's going to be 12%. So what happens is you've got an order here, you've got a trade right here, 275 short, 285 long, $125 credit. Now I'll just give you I'll just tell you that in the case of, no, I won't right now, we'll just leave it at this. So $125 credit. So let's take a look at the numbers. Probability of us booking a profit of a penny or more at expiration is 79%, right? The probability of us booking a 50% profit sometime between now and expiration is almost 90%. This is our delta, 0.962, our theta, 2.93. Maximum profit is $125, which is exactly equals the credit that you're taking into your account when you put the trade on. The maximum loss that you have here is $875. How is that calculated? Well, it does it for you right here, but let me just tell you so you know what how to do this. It's calculated by the width between the strikes that you've chosen. So if you pick a 10 point width, $10 width, all right, that's 10 times 100 because it's $10, but in option speak, that's times 10, so that's $1,000, right? That 10 wide spread is $1,000 in option speak. You're taking on a 125 credit, so you subtract that from that 1,000 potential loss, and you get a maximum loss of $875. Now, if you take a look, if I want to get more credit, right? Let's say I want to go to 295. Now I have $177 credit. But you can see what happens to my maximum loss because it's 2,000, 20 points, 2,000, minus the 177 that I have here. The farther you spread these out, the more credit you get, but the maximum loss increases exponentially. It doesn't make any sense to go out here 25 and another 2055. It doesn't make any sense. This close to expiration. This would be a trade you'd put on out in January of next year and trade around it. All right, we'll get to that in a minute. One of the a really safe way is just 5 points. It's $500 minus whatever you're taking in a credit, 72. So it's $428 max loss. Everybody understand that? Questions? So, as I said, the ideal credit is, well, in the case of the ideal credit that you should be able to take on, or that you'd like to take on a trade, is 1/3 of the distance. And you can search all day in this market, and if you see one, pop it up here right away. Because anytime anybody finds a 1/3 credit on the distance, please, please, please bring that up. All right, because that's a no-brainer trade, getting that amount of credit on it. Okay. The other thing you can do in terms of choosing your strikes is you can use delta values, right? So, like for instance, you can use 20. This is 21 and 16. You can use 20. Let's say we want to do 20 on the long, which would be this one, and then slide this up to 32. Actually not, because you're inside the expected move now. So the delta values are something you can use, 0.10 and 0.20 for entry in liquid contracts, and looking to close at 30%. But the problem is you're going to end up falling inside the expected move several times. So I've put an example in there about using delta values for entry, but for most purposes of trading, unless you find something unusual on the trade, then you're just better off staying outside the expected move altogether. So pick your short slightly outside the expected move, pick your long a little bit further outside the expected move, and you pick your long. The long is determination of where you go is going to be based on liquidity, obviously, right? You want to have volume. This is not, for instance, an extremely liquid trade that I would do with Target. I would probably look to do this instead. Take the 280, which gives me a lot of breathing room, given the fact it's trading at 257. And the reason for that is because it's got open interest of 1.14. Then I'd probably slide to the next best liquidity, which would be 290, and take $83 in credit on that, $10 out. Okay. Again, this thing changes constantly. This expected move changes constantly. If it's a high beta tick like a Tesla or a CrowdStrike or other ones like that, then you need to pay attention to when you enter that trade, so that you don't get stuck in it. Because you can enter that trade, especially as you're getting closer to expiration. This thing can move a lot based on the pricing based on the pricing of the options that you're in. Okay, so let me just walk you through the ideal model. The ideal model is we enter this trade, this target trade, 45 days prior to expiration. So that would be this is going to expire August 20th. This isn't even 45 days. So what we'd be looking, so what we'd look for here, if we wanted to do our ideal credit spread trade, is we'd go to August, or I'm sure there's not any liquidity in the weeklies here, is there? No. So we'd go to September 17th. So we'd stay outside the 45-day move. Reason you want to stay outside 45 days is because the theta burns, and you're going to get to a point where the fastest burn on the theta is going to hit at 21 days or inside of that. So you'd like to be able to give yourself enough time to get to that. And because of the randomness of the market, you don't know what's going to happen to this ticker between now and tomorrow, or between now and next week, or between now and a few weeks. So I try to take the date. You try to take the day-by-day randomness out of the trade by going out 45 days, or even a little bit further if you wanted to, right? So here we can see what the expected move is on target for that. See, right, and you got, see, there's no liquidity here. So this is probably not a credit spread you'd take, but let me just use it as an example. Let's just pretend that there's a lot more open interest here than there is, and a lot more open interest here than there is. So you take this at, sell the 280s, buy the 290s, you get a credit of $190, right? That's what we would do is we'd open it up $190. You got a probability of making at least a penny on that baby of 81%. But because you put there's so much time value left on here, you're gonna have a probability of pocketing at least 50% of this credit. And understand, if you want, you can size up on this, especially on highly liquid contracts. You don't need to do just one. You can take 5. You can take 10, depending upon your risk and the capital you can allocate. But understand, for every time that you add quantity, it's going to double this. See that? I just put 5 on. Now my maximum loss is $9,000 on that trade. And I'm going to pocket 5 times 190 in terms of what credit's going to go in my pocket. Which is basically if you could hold this, if you could pocket this 190 times 5 and hold it all the way to expiration or close to expiration, that'd be a pretty substantial gain for you. Now, what are the things that can go, okay, so you enter 45 days out, all right? And we sit and patiently wait for theta to start to burn this thing, to burn this right here. We're looking for theta to burn that. In other words, this ticker is trading 257, then 265, then 248. All the time, time is ticking away, and this is going down in theta value every day. Time value is eroding on this, which is what we want this to do. Okay. I have a rule of thumb on the ideal model of credit spreads that you take your profits at 50% and above. All right, and you do that when it gets to 21 days before expiration or later. In other words, when you get to 21 days before expiration, you either want to roll to the next month, which is to move this entire trade over to October, same strikes, or other strikes maybe a little bit further out of the money. Let's take a look what the expected move is for October. Okay, expected move here is 270 to 240. October 240 to 280, so it's a little bit wider. So you could roll these over, which is basically closing down this trade and just moving it over to the October trades. So, but ideally, what we want to do is we want this thing to get down to a buck, 90 bucks, I mean $100, $90, $80, and take your profits and roll it over to another trade like this. Now, Arax, he does these all day long, every day, and I think he's only lost one in his entire. I think he's only lost one in his entirety of trading this strategy. He does full expiration, but he also uses a much shorter time frame than 45 days. Understand, when you go into a shorter time frame, you're going to obviously get a lot less premium than this because the contracts just aren't worth that much, like if you went to July 30, right? So you went to July 30 outside the expected move. Here's what you're going to get. You're going to get, clear that. um, selling this one, buying this one, you're going to get a $50 credit. Now, there's an upside to doing this. The upside is that you can quickly take profits and flip this over and over and over again versus waiting 20, 25 days for that longer expiration to come into play. So you can play around with this depending upon um, what your strategy is. If you want to do a lot of these with small amounts, you can make a lot more money than sitting and waiting for theta to burn. But do understand that when you get further in to when you get further in, that you're putting more randomness of the market into play. So the closer you are to expiration, the more something can happen that can cause this trade to go awry, and you don't have enough time to adjust it properly. Okay. But there's different ways. There are different ways to play it. I mean, I'm putting out the ideal, which is sort of like a model. Doing this over and over and over again. Learn this process at 45 days in, so you can start seeing how these things look like in your account, and how they operate in the market, and the advantages to trading these. Because what you're doing here is you're trading a ticker, you're trading a strategy that has enormously, exponential greater mathematical probability of success than a debit spread or any naked call or put, right? It just works that way. There's nothing magical about it. It's just the math. Why? Because these things are priced precisely to expire worthless, right? Doesn't mean they always will, because of the movement when the IV shifts on the underlying ticker and the movement of this expands. That can happen. That's when you have to make an adjustment. That's why you want to take a look at this. This expands. What you do is you look at rolling it out to the following month to a higher expiration. So you roll it out to roll this one out to the 265, and then roll this one out to the 270. And it's easy to do. In fact, how do you do that? You can't do that. There's actually a roll order you can put in there where you pick the expirations and stuff you want. Okay. Any questions here? Nobody's really asking me much. Surprised Stealth isn't asking. He's usually on. He usually catches me. So Stealth is typing. Sam is typing. When you say roll it out, it is a there's a if you don't use Tastyworks, but if you go on here and you have a credit spread open right now, you can right click on it, and it gives you an option to roll, which means that it brings up another order where you pick an expiration and a strike and you roll it, right? So that's a function they have on here. I think Thinkorswim has it as well. It essentially does exactly what you're saying. It closes one down and opens the other, but it does it simultaneously. So there's no gap. So that if the market moves against you during a short period of time, or the bid, you take advantage of a bid ask working in your favor, the roll can work in your favor that way. And also it just helps with the math, because you'll see it pop up here. Because what you're gonna end up getting is you're gonna end up getting another credit further out, and everything is all in one place down here in the bottom. I don't have one I can show you right now, but if I did, I'd put it up here. But that's just a function of this, and most brokers have that. So, but it's the same as closing one down and open up another. It's just that it's all done in one quick transaction, right? Do you have? Yeah. Well, you mean the limit on the spread? Yeah, you could pick it up. You pick it. Like, for instance, let's say, well, it'll pop up the midpoint. It'll pop the midpoint up on the spread. She's asking, do you have to pick a limit price when you re-roll? It does it automatically, or does it do for it? Yeah, it does it. Yeah, it automatically puts up the debit. So, right here at 52, you can change that, right? You can move it down or up. So you always want to really pay close attention to the bid ask. Just make sure you look at this number right here, and look at this number right here, and make sure that it's not a long ways apart from one another. If it is, then make sure you slide this thing down maybe 3/4 of the way between the mid and here to get as much money as you can for it. You'll get filled here so freaking fast it'll make your head spin and you'll be in the red right away. Mr. Stone. Okay, here's the difference between a call and a credit spread. Let's find a different ticker. I'm tired of this one. Okay, watch list. $52-week lows, right? Okay, so here's a list of 52-week lows, right? And are they sorted by? No, they're not. So we sorted by IV, right? Okay. Mr. Stone is here with us, right? Okay, so once again, what we're doing is we're trying to find a ticker that we think we're going to make an assumption on. So just for purposes of argument here, let's take a look at stuff that's at an all-time low or 52-week low and say to ourselves, our assumption is it's going to go sideways from here, not going to drop much more, maybe go up, right? So that's an assumption I'm making for a put credit spread. Just the opposite of a call credit spread, which is where the thing is up near all-time highs. I don't think it's got a lot of upside to it, maybe a little bit, but I'm not worried about a little bit. In this particular case, Grub, 52-week low. I don't think it's got a lot of downside to it, maybe a little bit, but not enough to worry me. Maybe it goes sideways. Maybe it'll pop on me, right? So that's now let's take a look at a put credit spread. You with me, Mr. Stone? Are you with me, Mr. Stone? Okay. So you heard the call credit spread? You heard that part of it, didn't you, or not? Yeah, okay. So our assumption here is just the opposite. We're always looking for high IV, whether it's a call or a put, because those contracts and premiums are more expensive just because of the higher the IV is, the more premiums built into the contract. So we're looking for high IVs. Now here's an interesting one, BABA, because there's a lot of BABA players here. So this is a high IV rank, 45.8. That's a pretty high IV rank in today's market. It's hard to find them that high. So let's make the assumption we think BABA is going to slide sideways or go down from here. And if it does go up, not go up by much. So let's trade this baby. Now, we want to go out to September. So we pick September. We can see the expected move between now and September is about 195 to 232, I guess, or I'm not quite sure. This is 230 here, so this is halfway in between, I think, when you get here. So 230, 2.5. So now instead of opening up calls or opening up short calls and long calls as a trade, we're going to open up short calls and short puts and long puts, which means we look on the other end of this. All right, we look outside the expected move. The expected move starts here at 190. Let's see if we got enough liquidity here. That's okay. 285 volume today, 18 open interest. I think that's a reasonable contract from a liquidity standpoint. The spread is 83 and 05, so I'm probably going to end up having to slide my ruler to the right to take advantage of the upper end of this, right? So we do this. We're going to sell a 190. It's at 283. I'll take a look at just on this before we put the long on this one. You can see 283 to 305. So that's 20 bucks. That's a lot on the spread. 20 bucks is a lot of money on the spread. All right, the thing's only worth 283. So that's where you start looking very closely at this. So that's our short side of it. It's outside the expected move. It's 45 days or more from expiration, and it's got liquidity in the chain, so it's got everything we need. So now we want to do is we want to add a long to this. So let's just slide down very conservative trade to 185, and let's see what we got here for liquidity. Volume 50, not much volume today. That's got very substantial open interest. So you're going to get filled. The interesting thing about this particular contract is the spread is 2-2 and 3-3, so that's 11 cents. That's a really decent spread. So yeah, this is a tradable contract. So we're going to buy this one. So now we've got a 190 short to open, sell to open, I mean, and a 185 buy to open, and we got a spread here of 50 cents on the debit, on the bid, and 83 on the ask. We want to get as much money as we want on this, so I'd probably slide it somewhere around here and see if I get filled. Get filled at 75. That's a pretty conservative trade. You got a 5-point spread, so for every 5 points, that's $500. For every 10 points, it's $1,000. For every 20 points, it's $2,000. That's how much it equates to in terms of what you're going to have to come up with if you want to close the position, right? So the maximum loss on a 5-point spread is $500 minus whatever credit you get. So that's just it's constant. Here we got Trading for Dummies by Tasty, so they give you the numbers. You don't have to worry about it. Max profit, obviously 75. The most you can make is the spread, is the credit you're getting on a spread. It's got a probability of 50%, profit of 89%, probability of getting a penny of profit at expiration is 78%. This far out into the future, I would look to get rid of this at 50% or above. So I would look to whatever 50%. Let's say we get filled at, we're saying 75. So this is not exactly a great. This is points. This is $75 on a $5 width spread. I mean, ideally, we'd like to get on $5. You'd like to get, $1.66 here or something like that. That would be the ideal. A dollar is probably the minimum I would take this trade for, which is 20%. So, not a trade that interests me that much. See what happens if we slide it down here. Now you're increasing your risk obviously to 1,000 minus the credit. That's 117. But even there, I mean, 20% of 10, that's you $200, right? I don't know. Not really interested in this one because I don't see the credit that I get on. I don't see the amount of credit is not tantalizing me. Let's see what else they have up here for. Let's see if we can find IB. Let's find. Let's find some fast movers. They're called these. These are the ones that fly around a lot. They'll have pretty good. Probably find some decent IB here. TAL. EDU, GT, GLW, LUDM. Somebody give me a tick that you know well and like to play. What do you say we look at Amazon? I don't know what you guys like to play. Apple, Roku. Okay, I'll do Roku. Okay, Roku, let's go to September. Classic 40-45 day plus. Look at the expected move on this baby. 495, almost 495. 492.5 to 350. Look at how wide that is. Boom. Okay. So let's not a lot of liquidity there. Let's take the 500, sell the 500. Where's the next liquidity? Up, boom, boom. No. Nothing here. What's your assumption on Roku? Up or down? So you'd want to sell a put spread then, huh? Let's go see what we can get on that end. So you'd be looking to sell the. Oh, that's good liquidity there. Okay. So you'd be looking to sell. I'm sorry, wrong one. be looking to sell this one. Sell to open the 350, and you got plenty of liquidity. Drop to here. Liquidity is a little bit less, although the spread's pretty decent. So let's take a 10-point spread here. I'd be looking for at least $200 on this. I mean, ideally, I'd like to get $333, but you could get 200 because you can see where the ask up here at 230, way down here 155. You just slide it over to whatever 200, 203. Put your order in and sit on it and see if you get filled. Now you have a $200 credit. Maximum profit obviously is 203. Your probability of making money on the trade, even if it's a penny by expiration, is 77%. Your probability of capturing $100+ on this trade between now and expiration is 85%. Decent. And you also have to remember that when you're taking on a credit spread, it chews up a little bit of buying power, right? Because you have to have enough money to cover collateralized or in margin to cover in case something bad happens, which is the trade goes against you. So let's get to that particular part of the class. It's always my fun part. How bad can things go? Okay. So in this particular case, I'll use this as an example. What's the maximum loss that can occur here? The maximum loss that can occur here is $797, which is the $10 difference of 1,000 minus the credit you have of 203. Where does that maximum loss occur? It occurs when you get 339.99. You're at the maximum loss. So if for whatever reason this trade rolls down here, this ticker rolls down and the trade backs up into the sewer on you to 339, you're at your maximum loss of $797. You can't lose it. You can't lose any more than that. So the last thing you want to do if you get run over on the trade for some reason that gets you there and you haven't had a chance to stop out on it prior to it getting there, you don't want to touch it there, because now you still have 40 days left on this thing for that ticker to move around. And in fact, we jumped into probably one of the shittiest trades I did this year, which was on Etsy. It was a put credit spread just like this one, and I rolled it into earnings and we got smashed. Well, you know what? We made money on that trade, but we were at maximum loss for at least a couple weeks there. Can you quickly run through the ideal credit versus width? Ideally, you want to get 1/3 of the width. So $10, $333. So just divide the width by 1/3. If you find one like that, you post that in big, bold, red numbers, okay? Because those are hard to find in this kind of market because there's not a lot of volatility we're looking at. But this is 20% is decent if you can get 20%. Yeah, you're never going to get it. You're not going to get it right now. The market's just not enough. The IV's not high enough. 41 ranked. Now 80, 90 IV, that's where you're going to start to see that kind of, credit on the spread. So maximum loss occurs if Roku rolls down to 339. It's currently at 420. That's where you're at maximum loss of 797. Okay. If it ends up closing down here between 350 and 340, your maximum loss is basically you don't know exactly what it's going to be. You'd have to subtract the price of the stock at that time and then subtract the amount of your original credit on the spread. That kind of tells you what's going to happen in between. These guys, for instance, Tasty Trade, which is the educational arm of this broker dealer run by Tom Sosnoff. He's never stopped out or closed out a trade using credit spreads. In other words, the probability of profit is so high on these that he'll sit on this thing, right? And if he takes the full loss on it, he takes the full loss on it. But he puts probably 75 to 80 of these trades on every week, and almost all of them hit because of the probabilities. So he's saying, hey, listen, if this thing gets down to 345, fine. In next week, fine. I don't give a shit. By September 17th, as long as it stays above 350, I'm home free on this baby. So he doesn't. His philosophy is he doesn't stop out. And there's other guys that do the same thing, but they put on credit trade after credit trade after credit trade after credit trade, right? So they're basically playing, playing single deck blackjack over and over and over again, and counting cards. Facebook up 10 right now. Is that what you're saying? After hours? Or today? It's after hours it went up 10? Wow, I wonder why that is. Was there news? Didn't have earnings today, did it? ER in 6 days, and it runs after hours by 10? I don't see that as sustainable. What was the? I'll take a look at the volume. All right, so what's the maximum profit? Maximum profit is what you collected in credit, right? Stock stays below your short. The stock stays below your short call, or if it's a put, above your short put, right? Break even is basically lower strike, which is this one, plus the net premium received. So if for some reason this thing does roll down on you, let's say that this thing Roku's trading at 420 and it starts to roll down on you, getting close to there, that's when you roll it out to the next month. You take the strikes, you roll them down, and you roll it out to October. Okay, so now it's down here. If you had these October ones, you roll them, and the trade moves against you, you'd roll them down, and you roll them out. To now you're in January, and you can see where they end up here. So you got to adjust these because they're too much inside the expected move. But you can keep doing that and buying time on your trade. Now, what are the mistakes to avoid? Strikes too close to the underline. Strikes inside the expected move. All right. Use the expected move as your guideline. Keep these things outside the expected move. Don't get greedy. I understand. You can go like this and go like this and get almost $1,000 credit on there. All right. And actually, it's your maximum loss is not that much, except that you've decreased your probability of getting under 70%. All right. But you can play around with those if you want to experiment, especially if you're dealing with the January, if you're doing a credit spread all the way out to January and you're taking in $930 in profit, because at some point in time in the next 30 to 60 days, the market's going to roll. You know it's going to roll over 30, 60, 90 days. You got a lot of time there. And it's on that day or on that 2 or 3 day run where you end up making money, because this thing either runs up or runs down during that period of time. So there's different strategies you can use. I'm trying to show you the mechanics on it. I'm happy to answer questions about any of these things right now. So we'll do that. Questions? Yes. Yeah. That Stone, did you understand this? Did you walk away with an understanding on it? Or was that clear enough? Like I said, there's a lot of different ways to do this. This is the mechanics of it. So feel free to ask me questions or bring up ideas. Like for instance, Arax, he plays weeklies. He'll open up these babies on Monday, and let me just bring something up. For instance, how the hell did Facebook go up $10 after hours? I don't get that. Let me look here once. Facebook, baby. Look at that. There's got to be news. You can't go from 351 to 361 just like that. What's the news? Social bill would strip social media protection for health information. Strip online platforms such of their liability protections. Microsoft, Facebook, Amazon. What's going on here? Did you see this news? Amy Klobuchar introduces a bill Thursday to strip online platforms. I'm going to stop recording here, so give me a second. And so people want to listen to this.